Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to speak to Patrick Armstrong, CIO at Plurimi Wealth, one of the world's finest investment houses. So welcome, Patrick.
Good morning. How are you?
Well, very good. Yeah, perhaps not as good as you because you've had a terrific performance over the last 12 months. Up your global macro fund up 10%, which is which is much better than anybody else, certainly me anyway. And perhaps we can just start there. What's the sort of like the secret sauce behind that investment success over the past year?
It's our fund. We call it a macro fund because it's driven by top-down factors. What's happening in the economies with central bank policies, demographics, all of those things matter for our positioning. And we're a flexible fund that we don't have a strategic asset allocation. So I think many multi-asset funds have a neutral weight of 40% equities, 30% bonds, things like that. We don't own an asset unless we expect to get compensated to own that asset. So I think that's really been liberating. It's been something where for year to date, stagflation is what's driven markets. So that's toxic for equities and bonds. And because we don't have to own anything, we've been net short treasuries. So we had a 30% short in treasuries coming into the year. Treasuries are down 12%. So we benefited from the higher interest rates. We've been short euro, long US dollar. So we've benefited from the relative tightening from the US dollar versus the ECB that's not really done much so far this year. And the equities we've owned, consciously, deliberately, we've picked equities that are able to deliver returns in a stagflationary environment. So we've bought companies that have defendable profit margins, companies that have assets that are in scarce supply, and companies that produce services that there's much more demand for their services than there is supply available. So all of these things lead to pricing powers, and it's going to cause the margin squeeze in the rest of the index. So basically, we own a company like Møller-Mærsk. It trades at 2 times earnings, pays me a dividend yield of 14%. The amount of goods in the world that need to be shipped are just much higher than the amount of shipping capacity available. So Møller-Mærsk is creating a margin squeeze elsewhere and stagflationary consequences in the global economy because the cost of shipping goods is just higher for every company now. Møller-Mærsk is being able to pass on its higher costs to companies that want their goods shipped.
Right. Okay. Well, we'll come on to a few more of the stocks. That sounds like a pretty good one for investors to have a look through. But on that, you really sort of piqued my interest on the fixed income. What's your sort of view for, sort of bonds going forward? Because you've obviously had a bit of a home run. You're perhaps one of the only ones who are majorly short US Treasuries.
Yeah, so I'm still short 10% of the fund in treasuries, but yields have moved up they got past 3%, a little bit below 3% on the 10-year right now. So I do think yields are going to keep moving higher. Modus operandi of Western governments are print new money to pay off old debt. That's going to lead to inflation. It's protectionism and populism is the way you get elected and keep your job in democracies right now. So no government is talking about austerity. No government's talking about increasing taxes. In fact, the UK, I guess, is going towards cutting taxes, and the next prime minister is probably going to get elected with that mandate. So no government is fiscally responsible. That's going to lead to higher yields. Basically, governments aren't going to have credibility. Their bond debt to GDPs are going to go up. And yields are going to drift higher with the printing of money that's required to service the debts that governments are putting in place. So I think yields are moving higher. I actually think it's a 30-year trend where we have higher prices. Inflation is going to be much stickier than the consensus expects. 1980, when Volcker came into power, or not into power, to lead the Fed, he had a mandate to break inflation's back. Society, governments, and the Fed decided the costs of inflation were higher than the cost of unemployment. And they put in policies that created unemployment to get rid of inflation. We're nowhere near that today. We've got central banks that are still very slowly unwinding trillions of stimulus, just getting past zero interest rate policies, still negative interest rates in Europe. And that is stoking inflationary fires, even with inflation that's still at 8%, 9% in the United States. That'll come out this afternoon.
Yeah.
So policy is nowhere near restrictive. Even though we had a wave of Fed hikes, they're still nowhere near neutral. So every day that policy stays where it is, that stokes inflationary pressures. And from the 80s until 2010, Deregulation. Financial deregulation was a way to reduce the cost of goods. Then Lehman happened. Now we've got much higher financial regulation. We've got clean energy. That's much higher cost. We've gone from globalization to nationalism. So in the 80s and the 90s, 2000, companies outsourced to China to manufacture goods, outsourced to India for services. Now we've got protectionist policies. Reagan was saying, tear down that wall, Mr. Gorbachev. Trump's getting elected saying, I'm going to build walls. All of these things are long-term things that aren't going to change overnight, and they won't change until populations view inflation as a bigger cost to them than unemployment. And then we'll get a Volcker type who will come in, and we'll get back to countries working together, outsourcing. But we're in the stage where the pendulum's still swinging towards protectionism, nationalism, strategic reserves, hoarding assets, not being good neighbors, basically competing to control a world view. All of those things are incredibly stagflationary. And I think we're going to have ups and downs in inflation. I think inflation peaks today in the United States. For the next probably year and a half, it starts coming down.
Where do you think it will come in, Patrick? I think expectations are 8.8%, but obviously there's a lot hinging on it to drive sort of the Fed policy going forward.
Yeah, I think this will be a local peak and it'll come in. That's about right. I don't have a model that tries to guess what CPI will come in at, but the June inflation print should be the highest. If you look at July oil prices, copper prices, they're all down significantly. But I do think it's going to come in somewhere like that. And that probably sets the stage for a 75 basis point hike from the Fed, given the strong jobs growth we've got as well. So inflation's very high. It's going to start coming down, but it's not going to be killed off either, I don't think.
And so under that sort of like those auspices, etc., across the Western world, have obviously got the UK, and we've had Korea and the New Zealand putting up their interest rates, and the US is likely to say to 75 basis points again in July. The sort of the one which in the Western world which stands out a mile is obviously the Japanese National Bank, which just keeps on buying and buying. What's your view on the sort of the Japanese side? Because the 10-year JJBs are still, I can't remember, last time I saw they were less than 0.5%, I think.
Oh yeah, they're 0.25. So they've got an explicit policy to cap their 10-year yields at 0.25%. And that is not going to hold. So the biggest position in my fund today, we've got a 20% short position in Japanese government bonds, because it's like waving a red flag in front of a bull. It's just hedge funds will attack this position because it's not tenable.
You and George Soros, I guess, because he did the Bank of England, didn't he, back in 91?
Yeah, I won't be bringing down Bank of Japan myself, but I'll be participating from what happens. And it's producer prices grew 9.2% in Japan over the last 12 months. The yen's at a 24-year low. They're going to be importing massive amount of inflation. All the other central banks are hiking. The Bank of Japan can't be completely out of line and expect its currency to hold any sort of semblance of purchasing power. So the yen will plummet unless the Bank of Japan allows interest rates to start to move higher. So it's a hedge that costs me 0.25%, if I'm wrong, each year to short those bonds. And there's a very real scenario where Bank of Japan just says, we can't do this. We've got to let our interest rates float and move more like the rest of the world. So it's a very low cost short, and the returns are asymmetric because it cost me 0.25% to short it. And you can see a lot of scenarios where yields spike higher and the Fed or Bank of Japan isn't able to defend that 0.25%.
I guess even if yields don't spike higher, but the yen continues to depreciate, you still win, don't you? Because you've got a depreciating
the way I put
asset.
the trade on, it doesn't matter so much for me because
you
I'm doing it
hedge
through a
the
future.
currency.
Yeah,
right.
So it's a play on the interest rates. But yeah, if you were actually borrowing the bonds and paying back in yen that's cheaper, that would be another way to do it. But okay. I'm not playing it that way.
Okay. And then just on the whole derivative side of it, how do you manage? I mean, you're obviously an expert in what you do in shorting stuff, and this is an area that a lot of sort of professional investors get badly wrong. But how do you sort of like manage and size your position to sort of cap your exposure with derivatives?
So a 20% position sounds massive, but I just know the cost of it. Yields aren't going to go to -1%. And if it did, 20% times 12%, it would cost me 2% if it happened. So we do a thing called modified value at risk. We've got a risk budget for our fund where we try to get diverse contributors to risk. Our short Bank of Japan bonds or Japanese bond position contributes less than 10% of our risk budget. So it's a very large position, accounts for 20% of the fund's NAV, but it accounts for less than 10% of our VAR budget. So everything is scaled on a marginal contribution to value at risk is how we do things. And it ensures the fund is diversified. It ensures it's not a single bet going to drive our returns, which means we're never going to shoot the lights out. We target to deliver consistent, steady, repeatable returns. So not a fund, thank you for highlighting, we're the #1 fund in the Citywire database for macro funds over the last year, but it's not something we aspire to do. We aspire to deliver steady returns. And when the market's falling, those steady returns push us towards the top of the pack. When everything's running up, we might be middle of the pack, but investors who hold us over a cycle have been rewarded.
Well, you certainly did well over the past 12 months, no doubt about it. So you boys deserve a pat on the back. Now, most sort of like investors just look at sort of historical data. We've talked about obviously the CPI, which is a lagging indicator, the payrolls, which are supposed to be the biggest data point in the month. Again, it's lagging, etc. At least by sort of 30 days, if not 90 days, because they have to revise it. What do you guys sort of look at as leading indicators in terms to give you some insight? Because this is something that, everybody's trying to get a view on. The market's come down a great deal. It's hugely sort of like, it looks as though there's lots of good value out there, but is it a value trap? And what sort of forward leading indicators do you look at to be able to gauge whether there is good upside asymmetric?
We look at a range, and we don't have any edge in choosing what we look at. I think we look at the exact same things as everybody else. But right now, the market is really worried about a recession, and for good reasons. There's lots of things happening that may lead to a recession. I think we're in a recession in Europe already. But the United States unemployment is 3.6%. Wage growth is 5.2%, which is very high in nominal terms, pretty poor in real terms. But the US economy, 70% of it is consumption. And American citizens, when they have a job, getting pay rises, not worried about redundancies, they're going to spend. So I think the recession fears in the United States, if you just look at headlines and watch news, it feels like we're already in a deep recession, and we're not. And I don't even think the US is going to fall into a recession in the coming quarters because the job market is so strong. And the NFIB survey, where they ask a couple of thousand businesses every month, one of the questions they've been asking for 50 years, are you able to fill your job openings? Is it difficult to fill your job openings? And 51% of companies say we can't fill our job openings right now. So that's not something that sounds like imminent job losses are coming. Companies are finding it very difficult to hire, not planning mass redundancies. So I think the employment situation in the United States remains pretty robust, that anyone who wants to work can work. Wages maybe aren't growing in line with inflation, but people who want to work can work. And I think that means the US doesn't fall into a recession unless we get some shock that creates a lot of future unemployment. So the Fed, if it does what it says it's going to do, will create big unemployment. I think they blink when they see the economy's borderline recession, and they don't create that wave of unemployment. And that allows the US to basically have a higher inflationary environment, but not a recession.
And is that your sort of preferred sort of area, your region that you would invest if you were going to go long? It would be in the States, given that you've got it should outperform in terms of GDP compared to Europe.
I think it will outperform GDP. I look at valuations a lot, and I prefer a global company that's domiciled in Europe and getting a cheaper valuation than paying a premium for a global company that's based in America and paying that premium valuation. So I don't own any domestically orientated European equities, but I actually like the global equities in Europe because you get those companies at a discount. And it's going to be a massive tailwind that I don't think the market's pricing right now. As if you're domiciled in Europe and reporting revenues in euros or sterling and you've got dollar revenues, that's a massive beat for you already. If you're a global company in America and you've got euro revenues, sterling revenues, yen revenues, that's a massive headwind as well. So I think there's some scope where everyone says European companies are going to miss because of the economic situation. But if you're a multinational, that's going to be a really big tailwind. So I agree with you. US growth is going to be much better, but I don't know if I think positioning for companies outside of the United States that have US dollar revenue are going to be the winners in Q2.
And just on those ones, I did notice that you sort of like got positions in Astra and AstraZeneca and Roche. Is that a sort of like you like healthcare, defensive, and there's just good secular growth in that with oncology and obviously that dollar strength should help it because obviously they make a lot of money out in the States.
Yeah, my 3 healthcare stocks are all European based. You mentioned 2 of them. Novo Nordisk is the other one, and that's diabetes and obesity. So I think I've got a good exposure to a range of basically types of drugs they offer, cancer, obesity. Everyone was worried about COVID a couple of years ago, and cancer and obesity are bigger problems. And I think obesity is really, it's just such a high growth area, diabetes and obesity, given the demographics of aging and obesity, particularly in America, that Novo Nordisk has a suite of drugs that really are dominant in their categories and growing exceptionally well. So stable earnings, growth, reasonable multiples. Novo Nordisk is probably 30 times earnings, Roche 15 times earnings, AstraZeneca a little bit more than Roche, and get a little bit of a dividend yield there. So it's a way to avoid some cyclicality, pay a bit of a premium, and get good cash flow generation.
And how do you actually choose the sort of healthcare? Do you go best in class technology? Because I did notice, obviously with Astra and Roche, they've probably got, but there must be the sort of 2 best oncology franchises in the world.
Yeah, so that comes through. We use a range of different research providers. So we've got our system which screens a universe of 7,000 stocks. It highlights stocks.
Only 7,000?
Only 7,000, yeah. And we've got a number of tools we use to help us process information better than competitors. And then we do all the traditional side of things by talking to the experts. We've got contracts with Morningstar who have no sell side bias. I talk to all the sell side analysts as well. And they help us combine how we process data with views on what's happening with the company management, those kind of things. So we don't have an information advantage on any company, but I think processing information repeatedly, quickly, robustly is what our systems allow us to do. And that's led to a bit of an edge in making sure we're in companies that are meeting and beating expectations and trading at reasonable multiples.
And do you put in sort of like AI and big data onto that? Does that help you? Is it sort of tech, or is it really just sort of like you've got some excellent analysts out there that keep burning the midnight oil?
Yeah, so our equity selection, we've got a few licensed technologies in artificial intelligence where we've got different data providers and we combine them with some data feeds that we have internally. And yeah, I think no one has information advantages anymore on the big cap companies of the world, but there's just massive amounts of information available on thousands of companies, and every single day you get new data points. And machines are just better than humans at recognizing the things that are driving the stock market and driving individual equity performance. So that's where I think we have an edge, is processing information, even though we have no information advantage at all.
Right. Just coming back to Novo Nordisk, obviously they've been a fantastic diabetes franchise for years. I did see the headlines from Eli Lilly that they've come out with a blockbuster new sort of like obesity drug that has just got approval, I think, from the FDA. Is that just really a drop in the ocean compared to the scale of the problem?
Exactly, yeah. I think we're going to have more and more of these kind of companies coming in. Novo Nordisk has some first mover advantages, but Novo Nordisk is continuing to develop. All of its competitors are, and the problem and the population size who need these things is growing all the time. So it's not unexpected that competition is entering this space.
Yeah, no, you've got also all the emerging markets that, with the population increasing in sort of in wealth, etc. That's just going to lead to more diabetes issues and obesity issues overseas, isn't it? Not just in the Western world. So I'm with you. What's your sort of like broad outlook for equities going forward in terms of, sort of like obviously you're pretty negative on bonds still in terms of you think inflation's going to be
Actually, yeah, I'm negative on government bonds, but I've added a 40% position in corporate bonds over the last 6 weeks. And that's just because they've sold off massively. So corporate bonds in America are down 14% year to date as yields have moved higher and spreads have widened. I now think corporate bonds are going to deliver returns above inflation for me, which is my hurdle rate.
What spread do you get on an investment grade sort of corporate bond?
For a 3-year duration corporate bond, you can get about 4.5% for a pretty good quality corporate bond now in America on short duration. And that's what we're buying is short duration. So it's not massive returns, but compared to what we were getting earlier in the year, those returns I think look pretty attractive for me now. So I actually like corporate bonds, still short government bonds against it because interest rates aren't spiking higher anymore. I think they grind higher and the credit spreads compensate for that now. So I have changed my view on corporate bonds from having very little to now it's their biggest long position in corporate bonds.
And just on that one, what's the credit cycle like? I mean, if you've got sort of like, I'm guessing in investment grade, it's pretty solid. If you buy your Unilevers and your Roches and these kind of guys, then they've never gone bust. So they've gone through so many different wars. They've got a lot of legs to it, and they can always have access to the equity markets to raise money. But is there likely to be? We haven't had a credit cycle since the great financial crisis.
Yeah, so our view is that the US skirts a recession. That means there shouldn't be a wave of defaults. Europe falls into a recession. Manufacturing companies in Germany, I could see how there are some potential defaults there, but I think the government will help them out to avoid that. So actually, our view is that the recession isn't going to be deep. And defaults aren't going to spike up, but there will be defaults. Investment grade and short duration, those two things help you mitigate basically a slowing economy because the short duration has the pull towards par, and the investment grade even means you can have a few down notches before it defaults. So we own cyclical companies though. We bought a bond from DuPont. We bought a Heathrow bond the other day. So it's I don't mind picking up a bit of a premium to take some cyclical risk, especially if it is short duration.
Right. Okay. So you say you're positive on corporate bonds, you're negative on sovereign. What about, say, coming back on the broader equity exposure, etc.? Have we reached a sort of bottom in valuations? We've got S&P round about 16 times. We've got the FTSE on about 11. The FTSE 100, that is. We've got the FTSE 250 on about 13. I think the Euro stocks is roughly probably around about 13, 14 as well.
Yeah, so they're down to median multiples. All those numbers you said put them pretty much 40th to 60th percentile or what they've traded at over the last 30 years. The risk is that the earnings that make them look cheap aren't going to be delivered. And actually, surprising and probably unrealistically, analysts came into this year expecting the S&P 500 to deliver $220 earnings per share. Today, they expect $229 earnings per share. So the market's down 20%, and analysts have revised earnings estimates higher by 4% this year. And I think
largely on the back of energy, actually.
Energy is the big part of that. If you pull out energy, they're negative, but barely. So they're just on the cusp of break even. So energy has been revised higher, materials have been revised higher, but the other sectors haven't been downgraded really, and the market's down 20% year to date. So the risk is that margin contraction really destroys those earnings. If we fall into a recession, and I'm wrong, those earnings won't be delivered. But I do think the market moves higher in the second half as companies give cautious guidance for the second half of this year and really bearish positioning of investors and sentiment. I think that does set the stage for a second half rally this year. I don't think it'll be large. I think beneath the surface, there'll be a lot of movement that cheaper stocks will outperform expensive stocks. The no earnings technology stocks, I think they have another 30 to 50% to fall because a company like Uber were short. And it did its IPO in 2019. Its prospectus said very clearly, we may never make a profit. And the market rewarded those disruptive companies that had no path to profitability. They never designed a path to profitability. They had business models designed to create new users and revenue growth. No profit, that's never been part of the equation. And they have billions of market caps. So the shareholders and the founders got very rich because the market was paying price to sales multiples on these companies. And they just look for incremental revenue growth. But companies like Just Eat, Delivery Hero, Uber, the minute they change their pricing to a level where they break even, they lose 100% of market share because they're in hyper competitive markets. They've presented themselves as disruptors that are just doing things efficiently, but really they're just have a good that costs X and they're selling it at X times 0.8. So of course you're going to get revenue growth when you sell something for less than it costs you to produce. And it's just very competitive markets with no path to profitability. So I think those kind of stocks still have a long way to fall. Because nobody's disrupting the competitors in these marketplaces. You've got to create a monopoly to get pricing power, and there's nothing close to a monopoly in these food delivery companies, taxi companies, things like that.
Yeah, no, I think Jim Chanos is short Uber as well, so you're in good company there. Just in terms of that sort of earnings season, obviously it kicks off today, I think. Well, I mean, we had Pepsi yesterday, but we've got the major US sort of banks. What do you sort of think the key takeaways are going to be from the sort of the quarterly earnings season? Is it going to, and how's that going to blow through in terms of we've got a reset on, potential reset on analyst expectations for the S&P 500 for next year. I think they're about 249, I think I saw last time, for dollars per share for 2030, 2023.
So 2023 is going to have to be revised lower. But that's always the case. Analysts are just notoriously over-optimistic that earnings always start too high and then they get guided down to something achievable, and then the companies beat 80% of estimates by the time they report. And I think the theme of this quarter's conference calls are going to be we have very little visibility for the second half. And it's true, they don't have visibility, but consumers still have purchasing power. They still have a glut of savings that they built up during COVID. They still have jobs. I think business confidence is as low as it's ever been. Consumer confidence is as low as it's ever been. So I think Q2 results will be beats. Guidance will be murky. But as the quarter progresses and disaster doesn't happen, I think that's probably when we start to get the rally. So I don't know if we're going to get a big rally on Q2 announcements, because I think there will be a lot of hesitancy to guide for higher. I think CEOs will want to set a bar that they can beat and create some uncertainty. And as this quarter progresses, I think they'll get a little bit more certainty, and the revenues are still coming in every day. So I don't expect this to be a catalyst for a rally, but it might remove some of the fears that everything collapsed in Q2, which didn't happen.
So they might actually widen their ranges for EPS expectations for this year. So if they had a 5% sort of range last time, it might be 10% this time for the rest of the year.
Yeah, that's just natural, I think. But what will be beats? The oil and gas companies, what they'll say, and the shipping companies, we had incredible tailwind in terms of pricing. And the boom-bust cyclicals of cyclical industries in the past, every CEO who had massive cash flow, if they were an oil and gas company 10 years ago, said, we're going to explore and develop new production. And this time what they'll say is, we had massive cash flow, we're going to pay dividends and buy back shares and pay down debt. And that actually stops the boom bust from happening again, that everyone's pricing that oil prices are going to plummet, but there's no exploration and new production. No companies are going out to produce new oil, basically. They're buying back shares, paying down debt, and that stops that boom bust cycle from happening. So I really like oil and gas companies here right now. Shipping companies, I think the exact same thing. Analysts are pricing in massive new shipping capacity that brings freight rates down, but these companies are paying dividends, buying back shares. So the supply response that's always historically happened in these cyclical industries doesn't seem to be happening to me this time.
And you just take us, there's two, I think you quite like EOG and Shell. Do you want to take us through those ones? Because EOG is a big sort of shale gas producer out in the States, and Shell obviously is that integrated oil major. It's just,
there's nothing that they're doing too different than anyone. You could put Chevron in place of Shell. Those are the ones we've bought in the portfolio, but it's almost much of a muchness for the whole sector. That Shell's trading on 5 times earnings, EOG's on 6 times earnings, getting a 4% dividend yield, massive cash flow. And oil prices, I don't think plummet. Demand hasn't slowed. Everyone's talking about the recession we're in right now and the dire economic situation. More oil was consumed this month than last month, and I think that's going to continue probably into next month as well. You've got supply being curtailed out of Russia, and without new supply coming on stream, I think we're going to have a sticky high oil price that just everyday oil prices stay anywhere near current levels is just printing money for these companies. So in the long term, oil and gas, green energy replaces it, I guess. But in the short term, it's just massive cash flow. Everyday oil prices stay elevated for these companies.
And do you think there'll ever be a multiple sort of like upgrade at all? Because I mean, it seems as though, obviously the oil price has gone to the moon and the gas even more so. But you've got, even in respect to that, obviously the multiples are still really low, mid-single digits for each of them. There's not been multiple re-rating, certainly on the upside. No. And it seems as though investors are treating it as effectively as an inflation hedge rather than a long-term investment.
I'm actually doing that myself to some extent.
Oh, I see.
The biggest risk for the world economy is that basically oil prices create a steep recession. So this sort of hedges my risk against that, that we get into a 70 scenario. I don't buy oil and gas expecting a multiple expansion. It could happen if companies buy back their own shares aggressively. Pension funds don't want to get more than neutral weight in it because of green and sustainability concerns, things like that. But that's why they're cheap, basically. So yeah, I'm playing it for one of the reasons that you just said.
Yeah, okay.
And I love the cash flow that comes in every day. But a re-rating, that would be nice for these holdings, but I wouldn't expect it, actually.
And is there any chance of sort of like continued national jingoism? We've had obviously the UK putting a windfall tax on the North Sea oil guys, that being extended across the world, as if we do get, if oil prices stay at over $100 per barrel, there's going to be more sort of like public calls for one-off windfall taxes.
Yeah, and it's populism is an approach that works in government. That's a soundbite that resonates with everybody, but the consequence will be you just stop these companies exploring and finding new gas. So I think it'll be said a lot. Any policies put in place will be toothless, but it is a risk worth considering. But there's enough intelligent people out there that realize you do these kind of things and you're just making the problem worse in the future. You're getting a bit of cash right now, but you're stopping development for new oil and gas that your country will need strategically as well.
Just moving sectors now to sort of like we mentioned the sort of the Q2 earnings season's kicking off with the financials and the banks. Do you want to take us through sort of like, I mean, PayPal was a darling, obviously, of sort of COVID. The e-payments consumer bit focused business, and was trading at over $300 a share, I think, at some point in time. It's the last time I saw it was below about sort of 85, something like that, and it's on a low teens multiple, yeah. I believe.
So we actually bought PayPal for the first time yesterday. $72, $71.80, I think I paid for it. And like you said, yeah, it was at 300, which was way too much. I think it's 17 times on our forecast earnings right now. Yeah. So it's not cheap, but not expensive. Transactions are happening all the time. PayPal is still in a pretty dominant position for what it does. So I own Visa as well. But PayPal is a company that's still growing. It's trading at low multiples, well, fair multiples for the growth it is generating. And buying something at 72 that was 300, that doesn't mean you're buying it cheap. But in this case, I actually do think PayPal is generating earnings already. It's not like those no earnings tech companies that don't have a path to profitability. It's already generating cash flow, generating earnings. And we've had a real multiple compression on it, which is warranted. And it's at a price now that makes sense to me. So that's a brand new addition to our portfolio yesterday.
What's the PEG approximately? What's the PEG ratio on it? Is it sort of like, it's going to be about one, I guess?
Yeah, something like that. So it's, I don't call it cheap, but I think it's a stock worth having at these levels. And I looked at it in a derivative format as well. So we do structured notes on stocks sometimes. You could do it yesterday. We didn't put it on, and we might do it today, that we get a 17% coupon on an auto callable for it. with a 60% barrier. So it would fall down to 9 times multiple if our barrier got hit on that. So it would be a $42 strike that would make a 17% return on it. Unless the stock fell to $42, then the stock would be put on me. And yeah, I'd be very happy to have it at 9 times earnings anyway. So that's something we may do as well. But so far, we just bought the stock outright.
And that's sort of like when you do the options and stuff. It just is basically that the premium on a lot of options are so rich that you can pick and choose to a certain extent if you know what you're doing.
Yeah, you get paid a lot to sell the implied volatility on PayPal. You mentioned it fell from 300 down to 70. So there's a lot of volatility priced into that. People realize how much and how quickly these stocks can fall. So if you want to sell protection on that, people pay a premium to do that on those kind of stocks. So a 17% return, if it falls 30%, is a pretty attractive, and that'll be an accretive return for my fund. And if it falls 40%, I'll own the stock, but at 9 times earnings, that's not a terrible thing to be owning, I don't think, either.
No. So just moving now to sort of the multi-center banks. I understand you've got Citibank. Now, this one's been a perennial sort of like undervaluation compared to your JP Morgans and your Wells Fargos for ages. But I don't know what, it's less than 1 times book, I'm guessing.
Yeah, and it's 5 times earnings, 6 times earnings. I don't own many banks. So Citibank's the only bank we've got in our portfolio. We're short Credit Suisse at the moment. We're short.
So short Credit Suisse. Well, that is a surprise.
Yeah. So the same things that make Citi cheap, Credit Suisse looks cheap. I just think Credit Suisse is worse than Citibank in almost every way. So Citibank's poor on efficiency. It's poor on management and systems and controls, but Credit Suisse is even worse. They get fined for everything that's almost possible, it seems. So I prefer Citibank to Credit Suisse. So we're playing those two off against each other.
That's a pairs trade, is it, essentially?
Yeah. If we ever get a steepening yield curve, I'm going to make banks the biggest position in our portfolio, but we've essentially got no no bank exposure. We've got PayPal from yesterday, we've got Visa, and we've got Citibank in the portfolio on the long side of things. But yeah, I'm not massively bullish on banks. I think it is a value trap until we get a steeper yield curve, which I expect will happen when the Fed changes its guidance that it's not going to hike as much as it says it will, and 10-year yields start grinding higher because of that. That's when I'll go long financials, but that's a few months off, in my opinion.
Yeah, I've heard a lot of other smart investors saying banks are cheap for a reason, so buyer beware. Now, just moving to tech. I understand you've got, Alphabet's come down quite a bit, and you've got, I think it's a chip maker, ASML as well. Do you want to take us through those two? Because obviously we've got, go on.
Yeah, those have been long-term holds, so I've been punished on these stocks this year. Alphabet, it's trading probably below 20 times earnings today, given the sell-offs that have happened year to date. Ad revenue, it's got a dominant position. It's got defendable profit margins. If we go into a recession, ad revenue is going to fall, but we're not going to be in a permanent recession. So it's the kind of stock that you can buy and hold at 18 times earnings, 19 times earnings, where maybe at today. That's cheap, actually. So for PayPal, I didn't want to call it cheap at a similar multiple, but for Alphabet, given its dominant position, given its potential growth engines and YouTube ad revenue, you're going to make money on Alphabet if you buy it and hold it today, I think. ASML is another one that we've lost a lot of money on this year, but there's more demand for chips than there is supply. So if you are a car manufacturer, a fridge manufacturer, a phone manufacturer, you've not been able to get the chips you need to produce your goods. And all these companies moved to just-in-time inventory management over previous years. As soon as they wanted to manufacture something, they ordered the chips, they arrived the next day. And now it's been a year and a half where they've not been able to get the chips they need to manufacture their goods. So they're going to be able to get the chips they need this year, but all the purchasing managers are going to go into a hoarding behavior where they're going to say, I'm never going to let this happen to me again, and I'm going to pre-order all the chips I need for the next 3 quarters instead of just in time. And I think that sets a really favorable backdrop for the semiconductor stocks. So ASML makes those big double-decker bus-sized machines, the lithography that makes the chips for other companies. And their CEO says companies who are buying these lithographies, these machines basically, are saying, I don't even want you to do factory checks on them. That's how high the demand is for them. Just get them out to me so I can start producing. So I think they have pricing power. I think they have strong revenue growth, and the world's worried about cyclical demand. But I actually think the shortage in chips is going to be offset by companies hoarding them, and that's going to lead to incremental revenue growth even in a slowing economy.
And also, I think you've got that reshoring, haven't you? You've got the, if it ever gets through in Congress, etc., gets approved, you've got the chip manufacturing bill with Intel putting a huge $30 billion facility. I can't remember where it was, Texas or something. And you've got similar sort of things down in France. I think they're putting in big European new, because they don't want to have to rely on Taiwan. Or...
Yeah, it's strategic concerns around that. It's going to definitely be a policy tailwind, I think, there.
Yeah, just coming back to all things sort of commodity, I understand you've got some quite good plays in the soft area. You've got Archer Daniels and Mosaic as well, which are both trading on very low PE. Well, certainly Mosaic's on a low PE ratio. It's a sort of like a potash phosphate fertilizer business, and Archer Daniels is obviously the agricultural seed producer and soft commodity trader.
Yeah, I think we put these in after Russia invaded Ukraine, basically. So agricultural commodity prices really spiked up as potential wheat and grain out of Ukraine and Russia comes into question. And farmers came into this year expecting to get $5 or $6 a bushel for wheat. It got up to probably 12, and now it's trading around $9 a bushel. But that's going to incentivize them to farm every acre of arable land they have, which will require more fertilizers, more pesticides, more intensive farming, basically, and they're going to have the cash flow to pay for that. So Belarus is the biggest exporter of potash in Europe. They've got sanctions, obviously. Mosaic owns the largest potash reserves in North America and Saskatchewan. And yeah, 7 times earnings. That's a company that's going to beat, I think. There's going to be strong demand for North American produced potash for fertilizer. Corteva is another company that we have in the same kind of theme. It produced fertilizers and pesticides. It's had higher input costs, but it's going to be able to pass those on, in our opinion.
And that's going to come, so food inflation, because at the moment, obviously the farmers are certainly in this side of the Atlantic are really struggling to be able to pass that food price inflation into the supermarkets. But if they do that, then they're going to be, they'll be able to afford the potash, I guess.
Yeah, I think food is an inelastic demand. So I think that's one of the things you can pass higher prices on for generally.
Yeah, I think you're probably right. Okay, brilliant. Well, that's great on the stocks. Now, just is there anything out there? Because, I mean, obviously there's lots of things to worry about in terms of, hopefully we'll get a resolution in Ukraine. Hopefully China will manage to sort out its stop-start economy, etc. But is there anything other than that which is sort of like out there that people need to be aware of or watch? Are we going to have a blow-up, a bit of contagion, anything sort of like counterparty risk? I mean, heaven forbid, would Credit Suisse ever go under? I don't know. I
don't think so. No government will allow their bank to go under. So I actually own a significant amount of bank debt in the portfolio, and I'd rather have the debt than the equities at this point, because I don't think there's massive upside in the equities, but I don't think the banks are allowed to default. In terms of those unforeseeable tail events, it's very hard to predict.
Anything keep you awake at night? No.
One thing I'm staying away from that I would be buying every share I could get, Chinese equities look incredibly cheap right now. And I actually think China really stimulates its economy in the second half to deliver some growth after a write-off in the first half with zero COVID. But I'm not buying Chinese domiciled companies at this point, just because what's happened in Russia, it's so plausible. Similar things happen in China. They've already put in a lot of punitive measures, but if they make those measures very punitive for foreign investors, where they say you're not eligible to receive a dividend if you're domiciled outside of China, things like that. Given the buildup of China's military presence and the rhetoric coming out of them, it's not implausible that something very similar to what Russia's faced, China will face. So I prefer to play the Chinese growth that's going to come from the semiconductors, from the materials companies, rather than buying those Chinese domiciled companies at this point, which otherwise would be incredibly valued. But that's one area we are staying away from.
And what about the other battle zone, Bitcoin or crypto?
My view is Bitcoin's not going to be a winner in the long term. For me, it's it's not a medium of exchange. It's a vehicle that's a speculative investment. And when interest rates are zero, liquidity is being pumped into the market. You can speculate and dream and hope for something that makes no sense to make you rich. We're in an environment now where liquidity is going to be removed from the market. Interest rates are going higher. And there's no use for Bitcoin apart from speculation, in my opinion. And I think there will be a crypto that does everything Bitcoin does, but does it better. And when that happens, I don't know if the case to own Bitcoin makes sense, but that's opening a real can of worms, and we're probably going to end it there from the way you introduced that question. So
yeah, well, I mean, I have exactly the same view as you, Patrick. So we're both going to sort of like get an army of abuse probably from Twitter and stuff. But anyway, many thanks for all the fantastic insights, etc. If any investor wants to sort of like put some money into Plurimi Wealth, etc., put along some money in the funds, how best to do that?
Prosper Global Macro is the name of our fund. So if you Google Prosper Funds, that'll take you to a web page with application forms and fact sheets, things like that. And plurimi.com is our web page if you want to see what we're doing on the segregated accounts, those kind of things. There's information emails you can send things to there as well.
Well, great. Okay. Well, thanks very much again, Patrick, and well done over the last 12 months. Keep up the outstanding performance.
Thank you very much. Bye-bye.